Just over 2 weeks ago, I posted this video showing you guys my entire $30,000 growth stock portfolio. But that video was recorded before the stock market finally corrected itself, so now I want to take a look at that same $30,000, now $35,000 growth stock portfolio and see where all the stocks ended up and how the portfolio held up. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we're talking all things growth stocks. If you've watched my videos before, you'll notice that I have a different background today, and I'll explain this at the end of this video, but for now, let's keep going. So I did a similar video to this, a portfolio reveal, about 2 weeks ago, but since then a lot has happened. NIO went bonkers, Hylion went even more bonkers, Mercado Libre ain't doing too hot, and oh yeah, the market corrected. Give me the format. First, what kind of stocks I hold in this portfolio and which ones I don't, because there's some confusion about that in the last video. Second, the difference between a crash and a correction, and how you could have anticipated this recent move down. Third, I transferred a new stock into the growth portfolio, but it was one I already owned. I just transferred it from a different account. We'll go over that. And then fourth, the reveal itself, the big show. Now I know that sounds like a lot, but trust me, it's not. The first three are quick and easy and hopefully entertaining and valuable. So let's get started with part one, which stocks I own in this growth portfolio and which ones I don't. In my last video, I had a lot of people asking me about why I didn't have Tesla, Apple, Cheesecake Factory, or Microsoft in my growth portfolio. But guys, like I said in my last video, I do own those stocks, just in different accounts. Here's my Apple, here's my Tesla, here's my Microsoft, here's my cake, and so on. I personally just don't consider Apple, Cheesecake Factory, or Microsoft as high growth companies, and that's my personal opinion, so that's why they're not in this portfolio. I do consider Tesla high growth, of course, but all of my Teslas in my Roth IRA because I wanted those tax-free gains. But guys, I highly recommend you do not just follow me and put Tesla into your IRA as well, because an IRA, a retirement account, is not necessarily the best place for risky or extremely volatile stocks. The only reason I put it in there is because I still have 35 plus years left to contribute to my Roth IRA, which means I have a lot of cash to keep pumping in and a lot of time for it to appreciate. If you're older, this might not be the same situation for you. Anyways, part two, the difference between a crash and a correction and how you could have actually anticipated this correction. I wanted to address this because there's so many people out there talking about
what to do after the crash,
or
the crash is here.
But in reality, that was not a crash by any means. If you look at a chart of the NASDAQ, it pretty much just went back to where it was on August 20th, maybe 2 weeks ago, 2.5 weeks ago. That's not a big deal. That's actually very healthy. I understand people might do it for views or the clicks or get you amped up to watch their video, but I don't want to mislead you or give you any false emotions that are just unnecessary. So let me give you the facts. A correction is a market decline of more than 10% but less than 20%. And if you look at the 6-month one-day chart of the NASDAQ 100 from its peak to the bottom of the downward move, that was almost exactly 10%. Remember this. A crash is a rapid and often unanticipated drop in stock prices, often the result of a major catastrophic event like the Rona or an economic crisis or collapse of a bubble. And the key word here for me is unanticipated. I said I would show you how this could have been anticipated. This is the 6-month one-day chart of the NASDAQ 100 index. You could draw the same comparison with the NASDAQ composite index. The purple tool on the bottom is called the RSI, and it shows you when a stock index or the market is overbought or oversold. If it crosses this top purple line, it's overbought. Crosses the bottom one, it's oversold. So you can see that if we just put some drawings on this picture, every single time the RSI is overbought for the NASDAQ 100, it has a small little dip right here, 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 and here. This is the most recent one. After this ridiculous 6-month run, the NASDAQ was yet again extended, reaching all-time highs, ignoring all fundamentals, and very overextended and overbought on the RSI. So, with the given pattern of history, you could have anticipated this correction. That, combined with the fact that it was a long weekend and most of these traders on Wall Street were probably heading to their houses in the Hamptons, gave you a good idea that maybe, just maybe, this was manipulated. Personally, I thought this was a very healthy and good move for the market to move down before continuing to move up. We could see it on Tuesday continue to rise upwards more from where it left up, or come down a little bit more and continue to rise again. Of course, there's always a possibility that it continues to go down and goes over 20% when we enter a bear market, but personally, I'm quite confident that that will not happen. Now for part three, and this is more of an update, I recently transferred a stock that you guys know and love into my growth portfolio. This just means that I bought it a while ago in a different account and I recently decided to bring it over into this portfolio. The stock is none other than Virgin Galactic, ticker SPCE. Now the cost basis actually says $18.12, but I really purchased these shares for $16.48 per share. I'm not sure why the cost basis was changed during the transfer, and you can believe me or you can not believe me. I don't really mind either way. I know what I bought these shares for, and that's all that really matters in my opinion. Alright, so that's it for parts 1 through 3 of this video. Now for the part you're really here for, part 4, the big reveal, the big show, the reveal of my $35,000 growth portfolio, what each stock has done during the crazy past couple of weeks. The stocks are currently ordered by market value, which basically just means how much each position is worth if I were to sell them at today's current prices. And since we already revealed it, we're just going to start with space stock Virgin Galactic, ticker SPCE. We have 100 shares of Virgin Galactic. The current price is $15.92. We're down 12% on this position, but not really because this is our actual cost basis. We got it at $16.48 per share and it represents 5% of this portfolio. I have a couple videos on this one already on the channel. I'll put them up in the right. But Virgin Galactic is a space tourism company. It's led by Sir Richard Branson, and they hope to bring public customers into space. Just high enough to where you're technically an astronaut, but just low enough to where you won't fly away into the expanse of space forever and ever and ever. This is certainly still a very speculative play. They haven't even made their first commercial flight yet, but they have done a lot of successful test flights, and they've certainly, I've said that a lot, they've certainly come a long way. They have FAA approval for almost everything they need it for, and they've completed several successful test flights, and they have a lot of A-list celebrities and ultra-rich people who have already purchased their tickets to go to space. This is an incredibly volatile stock, as we've seen in the past, so I don't recommend this stock to anyone with either a weak stomach or not a lot of conviction. Now let's go back to the top with the biggest position in this portfolio. Stock number 1, it is still Livongo Gains, baby. We have 38 shares of Livongo in this account. We're up 65% on those shares. It's fluctuated a lot lately, and we're at average cost of $76.64 per share. It represents 13.5% of this portfolio. I've talked about this one so many times already on the channel that we'll keep this quick. Livongo is a telehealth company that focuses on helping those with chronic illnesses, primarily diabetes and hypertension. They recently merged with Teladoc, and this upset a lot of Livongo shareholders. Yes, this deal dramatically slows down Livongo's rate of growth, but once we all become Teladoc shareholders, we'll be very happy to own the dominant player in telemedicine, even if growth has slowed down a bit. I said I would keep it quick, so stock number 2 is Square. We have 29 shares of Square in this account. We're up 11% on those with an average cost basis of $131.82, representing 12% of this portfolio. In our last video, Square was actually stock number 6, so why did it move up so much? Because I bought a lot more. I think Square's potential with Cash App, Square Capital, and the small business side of things, and everything else combined is insane. But today, I want to talk about a slightly, potentially controversial side of Square. Last quarter, Square reported a huge beat on top-line revenue, raking in $1.93 billion, growing 64% year over year. And usually, that is fantastic. I mean, that is fantastic. But what you may not have known is that nearly half, or $875 million of the $1.93 billion in revenue was generated from quote-unquote Bitcoin revenue. Meaning if I bought $1,000 of Bitcoin, Square counted that as $1,000 of their revenue. Or if I bought $1 billion of Bitcoin through Cash App, Square would have made $1 billion more in quote-unquote revenue. Do you see the issue here? In other words, half of Square's revenue in Q2 was simply through purchases of Bitcoin on Cash App. Square didn't really do anything significant to their business to raise revenues so dramatically. Bitcoin was just popular in Q2. Square does make some money on these purchases, but it's only a 2% gross margin. But don't fret yet, there is another metric to look at. Because of this weird accounting method imposed by the SEC, a better metric to analyze Square's quarter is perhaps gross profit, which grew 28% year over year. Gross payment volume, however, decreased 15% year over year, which indicates that the weakness of their small business vendors is still there during this crisis. But losses were minimal this quarter, being kept to just $11 million. So that was a little more in depth than I'm going to do with all these other stocks, but I thought that was just some good food for thought that a lot of Square's revenue from last quarter wasn't necessarily real. And as a heads up, I don't think Square is trying to trick anybody or get tricky with their accounting. This is actually something that was imposed by the SEC on Square from what I understand. Correct me if I'm wrong. But let's move on to stock number 3, which is Upwork. This used to be stock number 5, but it rose in the ranks because I bought more of this one as well on the dip, which means we now have 250 shares of Upwork in this account. We're down 3% on those shares, a cost basis of $14.42, and it represents almost 10% of the account. Personally, I see Upwork as an undervalued growth stock, and that is extremely rare in today's market. In the last portfolio reveal, I said that I would be adding Square anywhere under $14, and I added right around there on this recent dip. Well, because to be honest, I was asleep when all the buying opportunity was there. But as I said last time, the gig economy is strong. Client registration and new job posts in mid-April surpassed pre-Roni Rona levels. Upwork's higher value clients continue to be very active on the platform, and Upwork is still on track towards 2021 EBITDA profitability. Moving on to stock number 4, which is Maxar Technologies. And you guessed it, I picked up a little bit more of this one too on the dip. We now have 145 shares of Maxar in this account. We're up 34% on those shares with the average cost basis of $17.63, representing just over 9.5% in this account. Maxar Technologies is a pure play on the space industry, which I believe is going to be the next major trend like AI or 5G. It's a turnaround story and a compelling one at that, in my personal opinion. Poor management and satellite malfunctioned actually destroyed their cash flow in 2017, and their stock price dropped over 90% over the next year or so. They accumulated a crippling amount of debt, but now new management is turning things around. They have a plan to deleverage the company, get rid of their debt, and they've been executing on it quite well so far, and it is especially apparent in their recent Q2 earnings. In Q2 of 2020, they reduced their debt from over $3 billion in Q1 to just $2.36 billion in Q2. And that's still a lot of debt, but this is just the beginning. Additionally, their major outstanding debts do not have to be paid off for many years, giving them ample time to work with the leverage they already have and continue to deleverage the company. Additionally, with the approaching completion of their Worldview Legion satellite constellation, their overall spend will start to dwindle, and the successful launch of Worldview Legion in 2021 could unlock many more use cases for Maxar satellites. I'm very excited about this stock, and the more I learn about it, the more stock I want to own. Stock number 5 is Facebook. You had to know this one was coming. We have 12 shares in this account with an average cost basis of $232.52. I don't know why I'm doing it in a different order. We're up 21.5% on those shares, and this makes up almost exactly 9.5% of this portfolio. Across all of my accounts, Facebook ends up being my biggest position, so again, Facebook gets actually 2 stars this time, hooray. And honestly, I think this stock needs no introduction. I've already made 2 videos about this stock, and obviously you can tell I think it's a great stock to buy and hold forever, because that's what I titled both of these videos. I'll link my older video up above because it's a bit more detailed and thorough if you want to give it a shot. Stock number 6 is The Trade Desk. We have 7 shares of The Trade Desk in this account. We're up just over 5%, which dwindled significantly from our last video where we were up probably over 20%, and that went away. No worries though, because we have an average cost basis of $418.91, and this makes up just over 8.5% of this portfolio. And again, in the last video I was talking about how it was overvalued at the time, and since then it's come down a bit, hence the move down to stock number 6. The Trade Desk is a programmatic advertising platform, which basically means they're the ones who help put those scarily personal and accurate ads in front of your eyes. Personally, I think it's rare to find such a high growth company that is already extremely profitable. Now, they have seen some deceleration in recent quarters in terms of net income, but this is a once in a 100-year event that we're going through right now, so long term, I'm really not worried. I'm still very confident in this company, especially as streaming wars continue to heat up. And if you didn't already know, I see the Trade Desk as a great indirect beneficiary of streaming services because they help put the ads on services like Hulu. Stock number 7, we are over halfway there, is Crowdstrike. We have 21 shares of Crowdstrike in this account. We're up almost 15%. We'll round up on that one with a cost basis of $109.39, making up just shy of 7.5% of this portfolio. In the original portfolio reveal, we were actually down 2% on this position. But now look at it. It's beautiful. At one point, we were even up 30% on the pre-earnings run-up, but 14% isn't too bad either. Crowdstrike delivered a stellar Q2 earnings report. Their annual recurring revenue, or ARR, grew 87% year over year. In other words, their subscription business model is still performing extremely well. Additionally, 57%, more than half of their customers use 4 or more of Crowdstrike's cloud modules, a number that has been steadily increasing over the past few years, indicating that customers are really liking their experience. And finally, Crowdstrike has continued to keep their customer retention rate above their own set benchmark of 120%. Meaning Crowdstrike is earning increasingly more revenue from existing customers than they are losing from exiting customers. Needless to say, I'm very excited to see what the future holds for this one. Stock number 8 is, drumroll please, NEO stock. We have 145 shares of NEO in this account. We're up 52.4% on those shares. We have a cost basis of $11.80, and it represents just over 7% of our portfolio. It went on a very nice run lately, so our holding is definitely up from last time. This is another stock I don't want to spend too much time on because I already have a video dedicated to it on my channel, but I will say this. A lot of people have called NEO the Tesla of China, and usually I don't really love those broad stroke comparisons like XYZ stock is the Amazon of XYZ country. However, in this case, I do have to somewhat agree. Both companies are building a luxury lifestyle, not just cars. Both companies are building and innovating energy infrastructure. Both companies are at the forefront of autonomous driving. Granted, Tesla may be a bit ahead in this department, but the biggest distinction amongst these two companies is that they will both likely be the leading EV manufacturers in their respective countries. NEO has the backing of the Chinese government. NEO is the poster child of China's green initiative. I'm quite confident that 1, China will not let NEO fail, and 2, China will not let Tesla be the leading manufacturer there. Lastly, NEO is beginning its global expansion, which is also very exciting. Overall, super happy with my returns so far. I still do think it is a volatile stock, maybe a little overbought or overhyped right now. If I see a better bargain in the future, I might add to my position. Stock number 9 is Mercado Libre, ticker symbol MELI or Melly. We have 2 shares of Mercado Libre in this account. I'll make that a better circle. And we're down about 2% on those shares. We have a cost basis of $1,105 per share, making up 6% of this account. Now, in the last video, we were up actually about 10% on these shares. And since then, obviously, it has gone down a bit, not performing the best. But Mercado Libre is a company based in Latin America that takes the marketplace concept of Amazon and combines it with the point of sale systems, financing, and Cash App aspects of Square. This is definitely a play that comes with some risk and some reward, as all do, but this one's a little more high stakes. On one hand, Latin America is a massive population that is still in the early stages of adopting online and mobile use cases for personal finance and e-commerce, meaning lots of growth is still ahead for Melly. But on the other hand, there are also many political risks in the same region that could cause detrimental side effects to Mercado Libre's business. If you're looking for a similar stock that might have less political risk, a stock that I also like but don't have a position in is C Limited. Nevertheless, I still do like my Mercado Libre investment right here. Stock number 10 is Shopify. We've got 2 shares of this one as well. We are up 20% on those shares with a cost basis of $808.28, making up about 5.5% of this portfolio. This company does everything from providing small businesses with an online presence to partnering with some of the world's largest corporations. Yes, Shopify is extremely overvalued even after the recent correction, but this is one of those stocks that I think is going to be similar to Amazon's stock price, where it's always very, very forward-looking, and the valuations probably will just never make sense. I like my cost basis here, and I'll be holding on tight, but probably not buying any more at these levels, even after the slight pullback. And our last stock for today, stock number 11, the one that has gained a lot of fans in recent events, Hylion, baby, or currently known as Tortoise Acquisition Corp. we have a mere 36 shares of SHLL in this account. We're up 160% on these shares with a cost basis of $19.36, representing 5% of this portfolio. And trust me, it did not start out at 5%. It was probably more like 1.5% or something like that. Don't check my math. Hylion is a company that manufactures hybrid drivetrains and helps retrofit truck fleets with their product. It's like a stepping stone from ICE engine to fully electric. In the last video, we were only up about 38% on this position, but look at it now. And if you're wondering whether or not I wish I had bought more before this humongous run up right here, my answer is, of course. Are you kidding? But do I regret not buying more? No. Because at the time, this was still a very risky and speculative play for me, so I put in the money that I was comfortable risking. If I'd put in any more money, that would have been too much risk for me, and in my personal opinion, that wouldn't have been in my best financial interest. Luckily, this speculative play worked out, and I was able to capitalize on some gains, and you just have to be happy with what you get, because hindsight is always 20/20. Ultimately, I think this recent run-up is 80% hype and caused by traders, and maybe another 20% is actual long-term investors, but we'll see. The reason I bought this SPAC and this particular EV play is because 1, I thought their business plan was very practical and extremely realistic and doable. 2, I figured there has to be some sort of stepping stone between ICE combustion engines, or I guess that's ICE engines and fully electric engines, and Hylion could supply that stepping stone in their product. And 3, I figured there's so much hype around SPACs and EVs, might as well play one that has some solid fundamentals to actually back it up if things go south. And that, ladies and gentlemen, wraps up the entire portfolio reveal since the correction. That shows you where my stocks stand. And mind you, this portfolio was started on June 16th. We're at a 21% return. And in terms of the dollar amount, we're actually up from our initial portfolio reveal, despite adding Virgin Galactic, which is a negative position. And the reason I bring this up is because, again, this proves that this was not any sort of crash. This was just a healthy move down for the market. And now the announcement. If you noticed, I have a new background, and that's because I'm no longer living at home. I moved across the country, and this is what it's going to look like for the next couple of months or so. And if you guys have any suggestions on how to improve the background or make it look a little nicer from your point of view, please leave me a suggestion in the comments. I'd love to hear what you guys have to say. And I know you guys love the quote of the day at the end of the videos. I love doing it too, so I'll find a way to incorporate it, even if it means I just have to hold up a whiteboard like this. And I mean, there's not one right now, but you know. So thank you guys so much for bearing with me in this transition. If you're still watching this point in the video, you are the real MVPs. Don't forget your peace and thank yous.